Hello viewers, we'll be going over the S&P 500, ticker symbol SPY. In this video, we'll be going over my trade idea of the week and how I developed that idea. So let's start off with the technical analysis. We're currently down 31 basis points on the 1-hour chart. What we have here is we are now approach to negative MACD. However, we have not reached oversold RSI. If we expand that further onto the 4-hour chart, we continue to remain in positive MACD. However, we see a slight divergence in play, and we are bouncing right off the 100 moving average, this orange line, as indicated back in, say, July 24th and as well as July 30th. We continue to use that as our temporary support. If we expand that further onto the daily chart, what we have here is the 18-day moving average. We bounce right off that level, so that will continue to act as our temporary support. And for resistance, we do want to make an attempt to breach above the $327 where we made back in July 22nd. So what we have, this bottom and upper range, these are my entries to my trade idea for the long and short positions. For my long position, I'm using a portfolio size of less than 1%, and my entry for my long position will be $316.83. That is this range right here, and my sell target for that is $327.52, and my stop loss is $313.35. On the other hand, if I were to take a short position, I will enter it at $331.09. So that is around this range right here. And my sell target for my short is $320.40, and my stop loss for my short is $334.73. So how did I develop this trade idea? It all comes from the day-by-day probability model, what we have right here. And if we progress to the 5th day, we have a 40% chance for the S&P 500 to fall between 0 to negative 2.2%. And on the extreme case to the downside, a 10% chance to fall between negative 2.2% to negative 4.4%. And to the upside, we have a 30% chance for it to climb between 0 to 2.2%, and further extreme case to the upside, a 20% chance to climb between 2.2% and 4.4%. So which one of these 10 models we should use as a reference? Let's take a look at the line graph right here. And the blue lines are current trend, and the line overlapping it happens to be the best match. So right here we have our current trend, and the trend below is the one that we found on the line graph above. This trend dates back to April 2nd to May 14, 2008. So let's begin comparing both the trends. So what we have is 1, 2, 3 points. And on the trend in question, we also have 1, 2, 3 points. So there's reason to believe that the trends and patterns are somewhat the same. The outcome and forecast should be fairly the same. So the model, again, that we just examined was April 2nd to May 14, 2008. So we have 1 day out. That'll be a Monday, and 2 days out will be a Tuesday, and so on. So 3 days out, 4 days out, and 5 days out. And back then, the S&P 500 fell roughly around 1%. So if we head back to the day-by-day probability model, what we have here, that coincides with this standard deviation of 40% chance for the S&P 500 to fall between 0 to negative 2.2%. If we examine closer on the technical performance, comparing the current trend, what we have right here, with the trend in the past, where we found on the line graph above. So we have similarities on the monthly high, somewhat identical on monthly low, and somewhat identical on 10 simple moving average, and somewhat identical on the 20-day simple moving average. And we don't have a 50-day simple moving average because we're only examining a 30-day trend. So these models are available in the link below, so do check it out. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.